It's the last edition for the week. Welcome to Business Morning. Good morning. I'm Chimeze Obi Iwago.
And I'm Ladi Williams. Thank you for joining us. Let's take a look at what's in the news now. All prices trimmed overnight gains this morning, but we're poised to end the week largely steady after rebounding from a sharp drop underpinned by expectations of supply will remain tight as demand recovers. Brent crude futures fell 7 cents to $73.72 a barrel after jumping 2.2% on Thursday. For the week, Brent was headed for a 0.1% gain. U.S. West Texas Intermediate crude futures fell 8 cents to $71.83 a barrel, following a 2.3% gain on Thursday. WTI was set to end the week flat.
And demand growth is expected to outpace new supply following the agreement by the Organization of the Petroleum Exporting Countries and Allies, known as OPEC+, to add back 400,000 barrels per day each month from August through December. Oil prices, along with other riskier assets, tumbled earlier in the week on concerns about the broad economic impact of surging COVID-19 cases of the Delta variant in the United States, Britain, Japan, and elsewhere. Benchmark contracts fell as much as $6 on Monday, but have recouped all of those losses as investors expect overall crude demand to stay strong, driven by the continued fall in oil stocks and rising rates of vaccination.
And away from oil now, COVID-19 pandemic has wiped off 20% from the $25 billion annual diaspora and remittances to Nigeria. This according to the chairman, Nigerians in Diaspora Commission, Abike Dabiri Erewa, while announcing the 2021 Diaspora Day celebration scheduled for July 25th. Mrs. Erewa said the home remittances were over 83% of the national budget and 6.1% of the gross domestic product. She, however, noted that various targeted programs were being implemented to shore up the deficit.
She explained that the remittances serve as economic buffers and safety nets to families for school fees, feeding, hospital bills, and many other social support systems. According to her, 30% of the remittances are channeled into investments, including real estate, commercial businesses, and others. The World Bank had said remittances by Nigerians in the diaspora declined by 27.7% in 2020. It had also put remittances into the country in 2019 at $21.45 billion.
And now to digital money issues. The Central Bank of Nigeria has announced October 1st as the date for the launch of a digital currency. CBN's digital currency pilot scheme, tagged Project Giant, will use the Hyperledger Fabric blockchain.
In a webinar with the fintech community and other stakeholders, the Apex Bank explains benefits of the e-Naira to include macro management and growth, cross-border trade facilitation, financial inclusion, monetary policy effectiveness, and targeted social intervention.
Very interesting.
Very, very interesting. So I'm wondering now that central banks are now coming up with their own digital currency, what would happen to your Bitcoin?
Well, Bitcoin still has that limited supply and unlimited demand.
Somehow, these regulators,
So,
they really understand, or rather, they know. I mean, the benefit of
yes,
the digital currency.
Cheaper to transfer money abroad.
I think it's all about understanding how it works,
Exactly.
and I think they are beginning to understand that. But every central bank would want to get a hold.
It's all about control.
Absolutely.
Well, the bulk of infrastructure financing in Nigeria comes from a direct budget investment, from fiscal resources, borrowing, and market-based financing. Nigeria has a huge infrastructure deficit, which considerably limits efforts towards achieving inclusive growth, sustainable development, and poverty reduction.
So what are the options for finance and infrastructure? We will have this conversation with a senior lecturer at Lagos Business School and the former director of Center for Infrastructure, Policy, Regulation and Advancement at Lagos Business School, Dr. Bongo Adi. Next, this is Business Morning. All right, we're being joined by Dr. Adi now to look at the options available to finance Nigeria's infrastructure. Good morning. Thank you very much for joining us, Dr. Adi.
Good morning, Chimeze. Thank you for having me.
So evidently, the government, at all levels, cannot adequately finance infrastructure in the country. It has then become imperative to seek alternative sources of financing. Let's begin with what appears to be a default financing option, which is borrowing. What's your view on borrowing to fund infrastructure, and what are the other available options?
Oh, okay. Borrowing as a way, one of the options to funding or financing infrastructure. Let's say funding infrastructure, not financing, because when we talk about financing, we're looking at market-based approach. Borrowing is not approach, especially when it is a public borrowing. So that is a kind of a borrow funding where government wants to determine what happens and which infrastructure in which regions in which sector gets to be done. So I think that is what determines and defines their borrowing behavior. Because government wants to be really in control of dictating where the funds go. Otherwise, it is not quite justifiable. It's not really economically rational, especially when we have known that government has competing needs in many areas, in social infrastructure, for instance. So perhaps physical infrastructure, we're talking about the roads, the bridges, the ports, the airports. These are market generating or market sensitive infrastructure in the sense that they really can be commercialized. So government doesn't really need to borrow funds, to do that. The private market should be incentivized to provide it. But when it comes to social infrastructure, where it is kind of difficult to really make the market case, the business case, let's say school education, where because it has positive externality, the market is not really suitable to provide such. So the externality, the market failure you have in social infrastructure seems to outweigh that is obtainable in physical infrastructure. As such, government should concentrate in provision or funding all those ones. But when it comes to the hard physical infrastructure, I think government's role should be to incentivize private provision.
All right, Dr. Adi, let's look at public-private partnership option here. How viable is this option, and what is our track record in the adoption of this model? And do you know of any success stories?
Well, we do not know of any significant success story today. Of course, when we talk about infrastructure, you're talking about billion-dollar size infrastructure, project finance, the ones that will be like have a gearing ratio of say 90-10, minimum of 80-20. I'm talking about the combination of debt and equity. So when you look at that, we've not actually had a significant action or activity on the PPP space, despite all the noise that has been made over the last decade and a half that we've been on the PPP journey. Of course, housing PPP has succeeded. Small, like mortuary PPPs have succeeded. Those are nothing that we need to talk about. But when we talk about, for instance, say Lagos Benin Expressway, okay, if it is going to be PPP, of course we attempted it collapsed. We tried with the port, that is the only PPP that seemed to work. Of course, it's just a PPP of a different vintage. It's just concessions, okay. And then even at that, if you speak to the port operators, they will tell you that government has not been able to live up to its own responsibility. Statutory or contractual obligations have not been met. So when our track record on PPPs is just dismal, and I mean everybody knows that.
Now, as you know, the private sector can only be attracted to invest in areas that are very commercially profitable, but not all the infrastructure are commercially attractive. Is this not a major limitation to PPP?
It's not a matter of, it depends on how, well, we have to look at the framework, okay, that defines roles, responsibilities, obligations, the contractual obligations. So we have to look at that. Before you set out on a journey to PPPs or attracting private sector, you have to ensure that you have the empowering or incentivizing institutional environment. If it is not there, there is nothing that the private sector, I mean, we're talking about businesses, okay? Everybody is in business to make profit, and not just to make profit. You need to ensure that when you make that profit or you invest, that your investment is secure. Okay, so in a non-secure environment, now insecurity is not just that we have, the overt conflict, the overt carrying of arms and destruction of government properties and all of that. We are talking about the institutional insecurity that we have. Government, Nigeria has been known to be awful when it comes to respect, for contracts. So contracts are supposed to be sacrosanct, but it is not in our own climes. So that is the biggest incentive to anybody coming to invest. So that is what people are looking at for. And until it's done, it doesn't matter what we do. I don't think that any serious investor, especially when it's about real infrastructure, a PPP, it has, it's capital intensive and it's over the long duration. So it's a long tenure. So if you're talking about that, then we haven't seen much of it. And if you look at our operating environment, if you consider our institutional environment, if you look at especially our institution of law and order, the ability of the courts, to protect contracts and defend that, we do not have a good record.
All right. Oftentimes, the PPP models mean higher prices to the citizens in form of higher tariffs, toll fees, and other user charges. The argument here is that the social costs will be too much for citizens to bear, especially bearing in mind that the poverty situation. For instance, let's look at the electricity tariff. That's actually a good example of the challenges.
Yeah, but yes, of course, when you decide what are the alternatives, that's a question to ask. So the alternative would be to borrow. It's borrowing, for government to be directly providing infrastructure, and government doesn't have the capacity in terms of expertise. Doesn't also have the, the real goodwill. There is no strong incentive for the government to manage infrastructure efficiently. So is that then the option? No, it is not. So yes, something has to give. You can't eat your cake and still have it. There is always a price tag. If we go the way of PPPs, yes, PPPs have been known to be, somehow costlier than the other, maybe direct provisioning by the government. But we're talking about expertise here. We're talking about efficiency, and then we are talking about government having to now focus on other essential needs of the public, not using the fund, the scarce resources to just be doing infrastructure, whereas the public sector. So yes, it's about as they say, externalizing costs and privatizing profits. But we're kind of it's about the lesser evil. So do we have to deal today with the absence of infrastructure, not having anything, or having to deal with paying a little bit extra, but then the service is available? So that is the decision that we need to make. But I don't think that is actually the issue, because if you look at the options available, we have not even explored everything. Now, I read in the news that Nigeria has appointed asset managers for the infrastructure company that was established last year. Mm-hmm. Okay, that is a step in the right direction. Okay, but I don't think that all these big news. We've appointed fund managers from Netherlands. We have this person and all these big names. They don't make anything. It doesn't matter. Okay, because if it's still the same operating environment, nothing will work. Okay, and I can tell you. We're also talking about government issued road infrastructure tax credits. Mm-hmm. So they have been given to big corporates, right? Because they ask for it. It's for a duration of 10 years or so. So where they can invest in infrastructure, and then their taxes, they enjoy tax relief, for the same sum over some years, and they also government gives them some kind of a lump sum, which is about the NPR plus 2%, as an incentive. Great. But I can tell you that is just for the corporate. It's just starting. But individuals in Nigeria, following the principle of fiscal subsidiarity, which I think that government needs to be looking into, you notice that people, you live in an estate, you provide your own roads. People pay. Before you move into an estate, you build a house, they require you mandatorily to pay a certain sum, sometimes 200,000, sometimes 500,000 or more. People pay for the estates in which they live, and the estates are able to do the roads. In most cases, also buy transformers and put the power lines. You see, and then we go back line, the history line in Nigeria, the history line, in the early 80s, okay, if you grew up in the Southeast, especially Imo State, the old Imo State, I can tell you this for certain, they all contributed. I was in primary school and we paid the little token, 50 kobo, 20 kobo, for the building of Imo Airport. And don't forget, that was just less than a decade or so after the Civil War. People were in penury. It was massive poverty, but people were able to tax themselves to build such. Now, what I'm saying is that there is an option that has not been explored, which is getting the private citizens to be involved. Now, you are giving tax relief to corporate. That's great. Can we also think of how to give tax relief to taxpayers, individual citizens, those who use their money, their little salaries to build the roads within the estate in which they live, and those who use their little incomes to build airports? Okay, so we can actually activate more activity. We can actually incentivize more people, individual citizens, if no matter how small it is. But when you now think about the pool, that's volume of funds that can be used to build this infrastructure, like airport, as it happened in Imo State and some other cities in the south in Nigeria. Yes.
Sure, Dr. Adi. Yes, talking about this tax credit, I mean, one would wonder how the tax credit is valued, because I think that's another challenge when you talk about the tax credit, the valuation, to make sure that the tax credit is not in excess of the project value. How can it apply in other critical infrastructure? Yeah.
Yeah. So again, if let's think about this way. If I were a corporate and I'm interested in building the road that I will build is the one that has something to do with my business. I mean, maybe the linking road to my factory, or the one that connects me to the port for the evacuation of my goods. Okay, that is the one I'll be interested in. So, which means the other roads that I have nothing to do with will not be serviced, will not be done. So, you see, that is the limitation of corporate tax relief as a way to fund infrastructure. So, it is only on those areas. But that's good. I mean, half bread is better than none. So, that's good in itself. You're talking about the burden of this. Wouldn't it be higher than the project, and wouldn't it be much, a huge, dead weight loss on the side of the public? Like I said earlier, what options do we have? Government has proved itself, especially in Nigeria. Government has failed over the years when it comes to provision of the needs, the infrastructure needs of the citizens. Okay, if the corporate sector, because you understand, they have the efficiency, they have the rational incentive, to drive it from end to end. So I think we can give it to them and then deal with the cost. Otherwise, we will continue to have this borrowing. But I like what is going on with the infrastructure fund, okay, the infrastructure company. Government has put in about 2.7 billion or thereabout, about 1 trillion naira. Then the infrastructure fund is supposed to build it up, raise capital of 15 trillion over the next few years. We have huge infrastructure need, right? So we have to explore all the options. That of corporate tax relief, yes, even though in the future it may be higher, but then it doesn't matter. We have to look at the valuation of the infrastructure that is to be delivered today. So I think the net benefit, when we look at the net benefit, it should outweigh whatever the future cost will be.
Okay. All right, Dr. Adi, thank you so much. We'll have to leave it there now. Dr. Bongo Adi is a senior lecturer at Lagos Business School. Thank you for your time on Business Morning.
Thank you very much.
All right, after the break, we look ahead of the Monetary Policy Committee meeting scheduled for Monday and Tuesday next week. What should we expect? That's our next conversation in moments. Do stay with us. This is Business Morning. And the Monetary Policy Committee of the Central Bank is set to meet next week amidst various economic challenges facing the country. This will be the committee's fourth meeting in the year. At the last meeting in March, the committee voted to retain all monetary policy parameters. The MPR wasn't changed at 11.5%. CRR was retained at 27.5%, and the asymmetric corridor was maintained at plus 100, negative 700 basis points around the MPR, and the liquidity ratio retained at 30%. all eyes are on the committee to see what they will do next. Motola Abimbola, investment analyst at Chapel Hill Denham, joins us now. Great to have you, Abimbola.
Thank you. My pleasure.
Good morning.
Good morning.
Yeah. So we've seen the emergence of a new wave of the virus and, of course, the slow rollout of COVID-19 vaccines, not just in Nigeria, but across Africa, which means that economies remain vulnerable to a new wave of the virus. How do you think this and other external factors will shape the direction of the MPC meeting next week?
Rightly said, and thanks for the question. So for the MPC meeting next week, because the MPC typically makes decisions on interest rates in the economy, they have to consider a number of factors before they arrive at their decision. And for the meeting next week, we think that three major considerations will be on the front burner of the MPC. So the first one would be the economic growth profile, particularly as we are seeing new challenges regarding COVID-19 and its potential impact on the economy. The second would be on the development that we are seeing in consumer prices. And then thirdly, we're going to see the MPC also, consider what is happening in the external sector, particularly on the outlook for the exchange rate. And going through this, one after the other, regarding the growth profile, I think not much has changed since the last MPC meeting that we had in May. As we all know, the economy made a recovery from recession in Q4 2020, and we saw the economy consolidate on that in the first quarter of this year. And the outlook is that we're still going to see, growth remain positive over the next, at least over the next, 2 to 3 quarters, due to low base effects, as well as the recent recovery that we are seeing in the oil market, and of course the fact that most of the COVID-19 restrictions that we had last year, most of them have now been removed. But of course, as you rightly mentioned, we are now seeing emerging downside risks to growth coming from the new variant of the COVID-19 pandemic. And we are also seeing an increase in cases of COVID-19 in the country, which has led to state governments and even the federal government introduce or try to, advise more caution on the part of citizens. So this will definitely have an impact on the growth profile. And beyond this as well, we are having, major, challenges, with widespread insecurity in the country, which is also, a major downside risk to growth. But all in, we still think that, the balance of risk, the economy should still be able to maintain the current positive growth trajectory, although the initial forecast of 2.5% GDP growth for 2021 will be very, very optimistic. But we still expect that the economy will still manage, at least, grow by 2% in 2021. Besides the growth profile, another key situation for the MPC is what is happening regarding domestic prices. And thankfully, we began seeing, inflation rates actually ease after touching, a record high, 4 months ago. Over the past 3 months, we have seen inflation rates, ease consistently, and the recent print of 17.75%, even though the number, perhaps suggests we're going to remain in a disinflationary environment at least over the course of this year. We still believe that this number still remains very, very high, even by Nigerian standards. So the long-run inflation level of Nigeria is around 4%. So we are having inflation rate, well above 15%. That suggests that more still needs to be done, by those fiscal and monetary authorities, to ensure that we have lower, we have much more stable and low inflation rates in Nigeria. The third factor for the MPs, which we think will be, is the development that we are seeing on the external sector front. Thanks to the recovery that we have seen in the oil market, we have seen, current account deficit actually reduce. In Q1 2021, current account deficit is less than 2% of GDP, over 3% of GDP that we had, for much of last year. Also, liquidity, in the FX market is also improving, albeit, very, very, marginal for now. The CBN has resumed supply of FX in the high yield window, where they are supplying roughly $25 million per day. Beyond that, the CBN also took a very, very interesting decision when they adopted, the high and window rates to be the official exchange rate in the economy. So that's a positive development. But more still needs to be done to ensure that we have, at least a convergence in the multiple exchange rates, structure that we currently have, and also to ensure that, we narrow the parallel market spread, which has remained, very, very, very wide. So by and large, it's going to be a number of factors, but we think that, the MPC, it can take comfort in the fact that, things are still moving in a positive direction regarding the inflation rate environment as well as the external sector development.
Yeah, looking at these factors or considerations facing the MPC. Now, central banks all over the world always face a monetary policy dilemma. Now, do you think there will be any trade-offs between any of these considerations?
Definitely, there has to be a trade-off. Of course, the central bank, if they actually decided to tighten monetary policy in order to combat, the aggressive level of inflation that we are currently recording, there would be, a negative feedback effect, at least on lending rates in the economy, which could affect, the pace of business expansion and even consumer spending. And of course, that will also have an impact, on economic growth. But the reality is that, for central banks all over the world, they usually choose their battle. So you select your policy goals and then you go, all the way, to actually make sure you achieve your goal. And in Nigeria, by law, the monetary policy goal or the mandate of the monetary policy in Nigeria, is actually price and exchange rate stability and not more on growth. So their core mandate is to ensure that we have, low and stable inflation within the target range of 6 to 9%, and that we also have stability in the foreign exchange market. Now, over the past, 1 to 2 years now, particularly since the onset of the COVID-19 pandemic, we have seen, both price and exchange rate stability come under intense pressure. But despite that, the central bank has actually chosen to actually support growth in the economy at the moment, given the fact that we have an extraordinary condition of COVID-19 pandemic, that there has to be, and there is a need to provide a bit of cushion, to both businesses and consumers to recover from the pandemic. But generally, by and large, if you look at what is happening globally, particularly for peer frontier market and emerging markets countries, many central banks in this particular category, they have now started to actually tighten monetary policy. So many of them last year, same with the CBN, they maintained an accommodative monetary policy posture to support businesses and households against the COVID-19 pandemic. But this year, given the fact that growth profile is now improving, we are now seeing inflation rates, coming back to the surface. Many have now started to, tighten monetary policy, in order to combat, inflation rates and also ensure that they have, a stable currency. And the central bank has, to an extent, also done the same thing, although they've not used the conventional monetary policy tools, that we are already accustomed to, such as the MPR. Rather, they have relied on administrative supply side tools, particularly the cash reserve requirements, and their balance sheet policy to tighten monetary policy. If you look at the fixed income markets, for instance, we have seen interest rates, rise across the board by over 600 basis points, even though the benchmark monetary policy rate has remained unchanged at 0.5%. So we think that at the meeting that is going to take place next week, very likely the central bank will probably, still maintain the MPR at 11.5%, but not because there is no justification, for there to be an increase in the MPR, but rather because the central bank, has actually chosen to, to use alternative, monetary policy instruments, particularly the cash reserve requirements and their balance sheet policy, such as common policy to effect changes, in the economy, rather than using the conventional monetary policy tools such as the MPR.
All right, so ensuring price stability is a core mandate of the CBN. How do you think the CBN has fared in, keeping with its primary mandate of maintaining price stability in Nigeria?
To be honest, the CBN is fighting a very difficult battle because when you look at the inflation problem in Nigeria, it goes beyond just monetary policy. To a very large extent, it's a supply side driven. And that's why, if you take, a long-term average of inflation rate in Nigeria, it's been pretty high. So 20-year average of inflation in Nigeria is around 12%. 10-year average is around 12%. And that shows that it is extremely difficult for the central bank to achieve very low inflation rates in Nigeria. And that's largely because of supply side constraints, such as infrastructure, and weak supply chains. Now, the onset of the COVID-19 pandemic, we have seen, inflation rates, we have seen inflationary pressures actually increase considerably, partly because of global factors. Because if you look at, food prices globally, they are on the ascendancy. So if you check the FAO's Global Food Price Index, they are up by more than 40% on a year-on-year basis. So there's generally a global phenomenon at the moment of rising food prices. But beyond the global factors as well, I also think that locally as well, there are some things we have done better. Particularly, when we had the closure of Nigerian borders in September 2019, that aggravated the already the already weak, food supply chain that we have, locally in Nigeria. And then we also had multiple rounds, of FX devaluation, that had a feedback effect, on consumer prices. So by empirical evidence, exchange rate has a pass through on consumer prices up to around 20%. So generally, so many factors, some factors outside the purview of monetary policy, outside the purview of the CBA, they have contributed to the current, high level of inflation in Nigeria. But some things could also have been done better, by both, fiscal and monetary authorities to ensure that, we have low and stable inflation rate in Nigeria. So it's been a very challenging period, but thankfully we are now seeing, inflation rates again, moderate. Although we believe that, over the next 6 months to 1 year, we're still going to have, inflation rates remain at double digits. So one thing needs to be done, particularly on the supply side leg, to ensure, that we have, on a medium term basis, low and stable inflation rates in Nigeria.
Now, as we count down to this meeting, how do you expect sentiments in the markets to shape up?
So for the market, to a very large extent, we think that the markets will discount, the outcome of the MPC, next week, given the fact that, the consensus view in the market at the moment is that the CBN is not going to change any of the policy parameters. And also maybe, as an aside, partly also because, the monetary policy, the markets already believe that monetary policy decisions typically lag the actual movement, in financial markets. So, for instance, over the past 6-7 months, we have seen interest rates in the economy increase rapidly. The long end of the bond yield curve, for instance, it has risen from roughly 7% in December 2020 to around 13% today. And despite that very aggressive 600 basis points movement in the 30-year bond yield, we haven't seen any change at all in the monetary policy rate. So markets will be heavily discounting, whatever the MPC, whatever they have to say next week, particularly because, the MPC has not been clearly recognized, participants in the market to be a lagging variable. And for us, our view on the fixed income markets is that, at current level, is probably look very defensive, given the fact that we have a number of liquidity, coming through into the market, from pack payments, but the number of payments, that came in this month, and we also had, rather, a bond maturity that came in the middle of the month. So the liquidity in the market is probably enough, but we also have a defensive fixed income market. But over the short term, as the CBN moves towards reopening, the FX market, once again, to foreign portfolio investors, we think that that would be that would be a scenario where we would have a much more higher interest rate environment as the CBN tries to make yields very attractive for foreign portfolio interest. And then for the equity markets, we're also pretty
Okay.
okay.
All right,
Thanks.
Motala. Yeah, so countdown. Next week, we'll get that decision. Thank you so much, Motala.
Indeed.
Motala
My
Abimbola,
pleasure.
investment analyst, Chapel Hill Denham. So great to have you. Thank you. And now for an opening call to the market, here's Anita Edetel. Investors at the equities market came back from the holiday with full force, dragging the bull along.
Yes, good morning, Ladi. Full force, that's the word. You can say that again, and that's because that was the biggest gain that we had since April the 29th, and we had about 330 billion naira added to the market's value at the close of Thursday's trading on the NGX. Now take a look at it. That amount in value translates to this amount in percentage, 1.67%, and that, of course, was largely driven by the shares of Dangote Cement, and this follows the second tranche of the company's proposed share buyback on shares. So now, also, when you take a look at the sectoral counter, you can see 4.01% is what that industrial goods giant did to its sectors counter. All of the counters were positive. Banking was up. Oil and gas was strongly at 3.11%. But the only laggard there was the insurance subsector. Now, if you take a look at the volume of transactions there, it was down in contrast to the previous session, which had about more than 400 million units of shares. The volume of shares carried out yesterday was down by 56.1% at 203.11 million units. Value was higher. Deals was also higher. But now to give us an insight into what happened at the market and then also an outlook into next week, let's talk to Rotimi Fakaejo, who is a trader at the NGX. Thank you for joining us, Rotimi.
Good morning.
Yes, good morning. So I'm sure traders are beginning to, rev up their smile because we've had that single day massive gain recorded on Thursday has sort of wiped off, brought us back to a positive month to date, 1.8%. So can you give us an insight into this?
You said it all because the market likely yesterday was driven, one, by the resolution between Oando and the SEC, which is a regulatory body for the capital market. Secondly, by the result that Total Nigeria PLC brought into the market, which was well received and it was also mind-blowing because comparatively to the same period last year, which was negative, and this time around, they're making a substantial profit. I think that also drove the market. Then thirdly, the share buyback proposal of the Dangote Cement, which had received approval from Securities and Exchange Commission. So all these put together actually drove the market. But what is going to drive the market more is going to be more results that are as good as what we saw in the likes of Total. So, and we are expecting more results today, and also we are going to see a lot of results coming next week. So definitely I foresee a situation whereby we have crossed 38,000 psychological line now for the OSHA index, and I believe strongly that that will be consolidated and it can be improved upon. So we are expecting that next week we're going to see more volume, more value, and also a sizable appreciation in the price. I mean, in the position of the OSHA index and market capitalization.
Okay. So thank you, Rotimi. So we keep our eyes open for that, and then our hopes high for that expectation. So now let's flip over to the unlisted securities market. It was also another bullish sentiment. 2.06% was what we did over there. The NSI is at more than 766, as well as the market cap also up. The volume was also up. Value was down by 28 the value was up by 2.07%, while the total volume of trades there was not too much. Was down by 28.54%. So now also let's move over to the fixed income market, where it was a kind of a mixed sentiment in for the Treasury bills and the bond market. But first, let's take a look at the bond market. The biggest there was the 26th of April 2019 instrument, which had about 10 deals there, worth about 4.10 billion naira. Also, the 26th of April 2049, that had 6 deals, cumulative 34 deals, valued at 17.52 billion. At the Treasury bills market, although yesterday it was a quiet, we expected that there would be an OMO auction, but I learned that there was no OMO auction there. But what we had as at yesterday's transactions was just 4 deals on the 30th of December 2021. And then, of course, for the OMO, just 2 instruments traded there. But now to bring us up to speed with what happened, especially when traders resumed from the 2-day Muslim holiday, let's talk to Bankole Odusanya, who's the head of fixed income at UBA. Thank you for joining us, Bankole.
Yeah. Good morning, Nature. It's actually a very liquid market this week. Federal allocations have come in. It's a short trading week because we've had just 3 days. Post the bond auction, we have seen some demand. Cherry picking of bonds with very good offers, we have seen those ones. But the attention is more on the Nigerian Treasury bills, where yields have dragged down for the long end to 8%. These were bills issued last week Wednesday at 8.67. So going into next week, we're expecting that the stop rate for the 1-year NTB could stop between 8 and 8.25. That's a possibility now. So the yields continue to drag down, but we're not seeing aggressive buys on the long end of the bond market simply because of interest rate expectations still being high. The government is going to borrow more, even though there are moves to borrow some external debt. We know that the National Assembly have approved $8 billion for that. So there's still some more caution on the long end of the curve, with some more demand in the Nigerian Treasury bill space. We're not having activities on the OMO end because the central bank didn't issue this week at all.
Okay.
And basically, it's been quiet on the OMO end of the instrument.
Okay. So thank you for that, for bringing us up to speed on that at the fixed income market, Bankole. So that was Bankole Odusanya, who's the head of fixed income at UBA there. So,
Anita, fingers crossed for the weekly close. Thank you so much, Anita. All right, so we'll take another quick break. When we come back, we'll do an opening call to London. Do stay with us.
Okay, let's cross over to London now. We have Juliana there. Good morning, Juliana. Well, let's get started. We're on the data front. Retail sales in the UK staged a small recovery in June, rising 0.5% from the previous month. That's slightly better than the 0.4% gain predicted by economists. What's driving that?
Good morning, Chimeze. One thing and one thing only, football. It was the Euro 2020 tournament, and Brits spent heavily during that period, and that's the reason why there's been a marginal uplift in retail sales in the month of June. We had that data earlier in the week showing that for the first time, online sales for groceries have declined. And so there's been a mix and ebb and flow of retail sales in the country over the past couple of months. A lot of this is got to do with lockdowns and the lifting of restrictions and consumer habits and the weather and, of course, sport and football. But it's football that's lifted this up so much. A percentage rise on food. I believe food sales are up about 9%, even though June wasn't as good as maybe some economists would have forecast. It's certainly way above pre-pandemic levels, and long may it continue.
And the PMI is also expected this morning. Any idea what the numbers are saying?
Yeah, I just got a glimpse of that before coming in the studio. It's actually come in really low. Of course, this is just the flash PMI. So this takes a good forensic look at the private sector in the UK just to really see how the economy is ticking on. And it's come in at about 57.7. The benchmark, of course, is 50. Anything above 50 does show growth. But 57.7 is the lowest number that we've seen since March this year. So clearly something is going going wrong. I believe it was yesterday, Chimeze, we spoke about the Bank of England CHAPS data showing that credit card data and debit card data is down. People are using their cards much less. May GDP coming in at 0.8%. There are shortages, chip shortages, pingdemic chaos. Lots of businesses in the UK at the moment having to slow down. But this could worry some economists because, of course, if you speak to the OECD, every other kind of financial global institution, they're looking at Britain to stage a very strong recovery, and all hopes are on Q2 to get us out of this pandemic. But we are starting to see some signs that perhaps consumer confidence is waning. But this is just a flash, so we'll have to wait and see what the final data is next week.
All right, we'll still have till the afternoon to say, thank God it's Friday. All right, let's look at the crypto market there. Well, Laddie, what's up?
Well, we're having a Green Friday, unusually, but it's still a mixed sentiment with a couple of major caps there in the red, stable coins also in the red, but Ethereum is above the 2,000 region this morning. Market cap, 1.34 trillion, up about 3.09%. That's for the total crypto market. 24-hour volume is down 15% this morning. We have Bitcoin dominance at 45.55%. Price of Bitcoin, 32,592, up by 1.85% this morning. 24-hour volume trading Bitcoin, $20.38 billion. Let's bring in Michael Inaji now, digital market analyst. Hello, Michael. Thank God it's Friday and thank God it's green.
Hello, Laddie. Good morning. How are you?
Good morning. Good morning. Well, 80-plus countries, have are in talks to launch, CBDCs, and here in Nigeria, the central bank is projecting to launch in October. What do you know about this?
Yeah, so Nigeria, they're hoping to launch this CBDC. Effectively, I think they're going to be calling it Giant. It's going to be a derivative. It's going to be made off the Hyperledger blockchain. So basically, the goal for them is to mostly help bank the unbanked. And what I mean by that is everyone in Nigeria knows that our banking infrastructure is nascent at best. You go to an ATM and, you wait for, you can wait up to 20 minutes if you're lucky. Or sometimes some people send people to go to ATMs because just the lines are too long. So overall, Nigeria does not have enough banking infrastructure. We don't have enough ATMs. We don't have enough physical banks. So Nigeria has a unique chance here to what's called leapfrog. Effectively, when the mobile phone came, we had Nitel, but we leapfrogged. We went into the future. We didn't need all the mobile phone lines. And the CBN is effectively hoping now that they can recreate that. They don't have to build all the banking services and all the banks that we would have needed. We can use effectively a CBDC. And the thing about CBDCs is you can run monetary and physical policy all at the same time because everyone has a unique, basically a wallet address, and it can help with things like remittances. So effectively, like let's say you wanted to send USD over, you can now have like a Naira account where the CBN can deposit the money for you. And for the CBN, it definitely does remove a lot of the principal agent problems where people come and there's some graft in the currency exchange. Basically, having the CBDC coming, it really does tighten up the economy a lot for the Nigerian government and how they can control it. And overall, it's net good because at the end of the day, Nigeria has one of the most unbanked populations in the world. Yeah. And anything that we can do to move that goalpost is better for everyone.
Okay, looking at CBDCs generally, do you think they'll have, limited supply like Bitcoin?
No, I think the CBDCs will be just exactly like what we have today. At the central bank's whim, at the CBN's whim, they will be able to edit the supply. They'll be able to increase the supply. Also, another unique feature about CBDCs is it allows the CBN to basically say, oh, you can't spend the money that we give you on or drugs, alcohol, whatever it is. If we give you that money, it's to only spend it on food or whatever it is. Effectively, you can tell people what they can spend their money on. And if they spend it on something counter to what you need, you effectively can burn the currency. So ultimately, it gives the CBN more tools to basically financially tighten up the economy, whatever is physical or monetary policy that they wanted to do.
Okay. All right, Michael, very quickly now, this bounce we see in the market, is it going to be sustainable or is it some kind of dead cat bounce?
100% you're right. This is a dead cat bounce. We could see like a relief rally to 40K, but that's quite improbable. This is more likely a dead cat bounce. I still believe 25 to 20K, like we said earlier, is still intact, and it's on the horizon. This is like we're trying to kill a giant whale, so it's going to take some time. It's going to come up for air like it's alive, but overall, the whale's going to come down, and we're going to slay it about 20K.
Okay. All right, Michael. Always great to have you. Have a great weekend.
Thank you so much. You too, Laddie.
Thank you. All right, Chimmy, there you have it. It's looking good. Top alt by market cap. We see XRP is the biggest mover there, up 3% at 60 cents. Binance Coin, $298, up about 2.22%, even though a lot of regulatory clampdown is coming on BNB, but it is holding head above water.
Let's just hope that those greens that we're seeing there will enter into the weekend.
Right.
And of course, I do agree with what Michael said there. Hopefully, the central bank would have, made provision for capacity to actually go about this, digital currency that they are trying to come up with, so that it doesn't become a mess.
Exactly.
If I'll put it that way.
Yeah.
Anyway, that's it on the program for today and, of course, for the week. Thank you for being part of it. I'm Chimeze Obi Iwagu.
And I'm Laddie Williams. Don't forget, we still have Business Incorporated at 1:30. Thank you so much for watching. Bye for now.